If you have money in the stock market right now, retirement funds, index funds, anything tied to the S&P 500, the next 30 minutes might be the most important financial warning you hear this year. Everyone's talking about the AI revolution. The headlines are breathless, the valuations are astronomical, and the money keeps pouring in like there's no tomorrow. But here's what they're not telling you. The insiders, they're worried. The data, it's devastating. And the timeline, closer than you think. In 1999, everyone knew the internet would change the world. They were right, and they still lost everything. This is the story of why 2025 feels exactly the same, and what you can do about it before it's too late. Chapter 1. The Euphoria Machine. Right now, we're living through the greatest investment mania of our lifetime. Most people don't even realize they're part of it. Look around. Every company is suddenly an AI company. Every startup pitch deck has machine learning somewhere on page 1. Every earnings call mentions artificial intelligence like it's a magic spell that turns losses into profits. At this point, you could slap AI powered on a toaster and watch your stock triple. Actually, someone probably already has. But here's the number that should make you pause. In 2025, AI firms accounted for 80% of all U.S. stock market gains, not 20%, not 50%, 80. That means if you own an index fund, if you have a 401k, if you've got any exposure to the American stock market at all, you're not making a diversified bet on the economy. You're making a concentrated bet on artificial intelligence. Whether you meant to or not, the Magnificent Seven, Apple, Microsoft, Nvidia, Google, Amazon, Meta, Tesla, these companies now drive everything. When they go up, the market goes up. When they stumble, everyone falls. And the thing about concentrated bets, they work brilliantly, right up until the moment they don't. The money keeps flowing, the valuations keep climbing, the headlines keep promising that this time the revolution is real. The technology will justify any price. But behind the euphoria, cracks are starting to show. And to understand where this is going, we need to look at where it's been before. Chapter 2. Echoes of 1999. Let me take you back to a party that ended badly. The year is 1999. The internet is going to reshape the world. Everyone knows it, and everyone wants in. Companies with no revenue, no profits, and no clear path to either are going public and doubling on their first day of trading. Venture capitalists are throwing money at anything with a .com in the name. Your neighbor is quitting his job to day trade tech stocks from his basement. Sound familiar? Pets.com raised $300 million to deliver dog food. Their sock puppet mascot had better name recognition than most senators. Webvan was going to revolutionize grocery delivery. They burned through $1 billion before declaring bankruptcy. eToys, Cosmo, Boo.com. The graveyards of that era are filled with companies that seemed unstoppable, right up until they stopped. Here's what everyone forgets. The believers were right. The internet did revolutionize modern life. It revolutionized commerce, communication, entertainment, work itself. Every prediction about the internet's transformative power came true, and investors still lost 90%. Because being right about the technology doesn't mean being right about the price. Amazon was a real company with a real future. It still dropped from $107 to $7. Cisco was building the infrastructure for the entire digital revolution. It fell 80% and took 15 years to recover. The .com crash didn't happen because the internet was fake. It happened because prices got so disconnected from reality that when gravity finally kicked in, there was nowhere to go but down. You can probably see where this is going. Today's AI investors are making the same argument the .com investors made. This technology is real. This time is different. And they're half right. The technology is real. But that's exactly what they said about the internet in 1999. History doesn't repeat. but it rhymes. And right now, the rhyme scheme is getting uncomfortable. The dot-com bubble taught us one thing. Hype is not revenue. So what does the revenue actually look like for AI? Chapter 3. The numbers don't lie. MIT just released a study that should be on the front page of every financial publication in the world. It's not. So let me tell you what they found. Last 2024, enterprises across the globe poured somewhere between $30 and $40 billion into generative AI. 40 billion? That's not a typo. $40 billion of corporate money invested in the promise of artificial intelligence. The return on that investment? 95% of those organizations saw zero measurable ROI. Let me say that again. 95%, zero. Not disappointing returns. Not lower than expected returns. Zero, nothing. The money went in and nothing came out. If your surgeon had a 95% failure rate, you'd walk out of the hospital. If your mechanic failed 95% of the time, you'd never go back. But for AI investments, companies lined up around the block to hand over billions. Where did all that money go? Mostly into expensive implementations that never delivered on their promises, chatbots that confused customers, analytics tools that produced insights nobody acted on, automation systems that required more human oversight than the processes they replaced. And it gets worse. A new phenomenon has emerged that researchers call AI washing. Companies are slapping artificial intelligence labels on products and services that have nothing to do with actual AI, just to boost their valuations, just to attract investors, just to ride the hype. It's the dot-com playbook all over again. Remember when companies added .com to their names and watched their stock prices soar? We're doing the exact same thing, just with different letters. $30 to $40 billion, 95% failure rate, and the money keeps flowing. You might think, surely the people running these companies know this. Surely the insiders see what's happening. They do, and they're saying it out loud. Chapter 4. When insiders speak. When the dealer tells you the game is rigged, and you keep playing, at some point that's on you. In 2025, Sam Altman, the CEO of OpenAI, the man who arguably started all of this, the face of the AI revolution, publicly acknowledged that, yes, there's a bubble. His words, not mine. Think about what that means. The person who benefits most from AI enthusiasm, the guy whose company is valued at levels that exceed most national economies, is telling you that prices have disconnected from reality. When was the last time you heard a CEO admit their industry was overvalued? But Altman isn't alone. Ray Dalio, the founder of the world's largest hedge fund, the man who's been navigating markets for half a century, compared current AI investment patterns to the dot-com mania. He's seen this movie before. He knows how it ends. The Australian Financial Review went further. They called this the most anticipated bubble in history. Not a possible bubble, not a potential bubble. The most anticipated bubble in history. Everyone sees it coming, and everyone keeps buying anyway. Why do insiders speak up? Sometimes it's legal cover. If things go wrong, they can say they warned you. Sometimes it's ego. They want to be on record as the smart ones who saw it coming. And sometimes, maybe, it's genuine concern about what happens when this thing pops. But here's the part that should terrify you. When the people at the very center of a mania start issuing warnings and the market keeps climbing anyway, that's usually a sign you're approaching the end, not the beginning. Markets can stay irrational longer than you can stay solvent, but they can't stay irrational forever. So the insiders know, the numbers are clear. But how fragile is this house of cards, really? The answer is terrifying. Chapter 5. The Magnificent Fragility. 5 companies, just 5, and they're holding up your entire portfolio. Here's a number that should keep you up at night. The top 5 AI-related companies now make up 30% of the S&P 500, That's the highest concentration in 50 years, half a century since before most of us were born. Your diversified index fund, it's basically 5 tech companies in a trench coat pretending to be the entire economy. It gets worse when you zoom out globally. Those same companies represent about 20% of the MSCI World Index. That means retirement funds in Japan, pension systems in Europe, investment portfolios on every continent. They're all riding on the same handful of American tech giants. This isn't diversification. This is concentration risk disguised as safe investing. Think about what happens if one of these companies stumbles. Not fails, just stumbles. If Nvidia's growth slows, if Microsoft's cloud revenue disappoints, if any crack appears in the AI narrative, the entire global market feels it. Your retirement account, your kid's college fund, the pension of a teacher in Germany who's never thought about artificial intelligence in her life. All connected, all exposed, all betting on the same 5 horses. In healthy markets, risk is spread around. Different sectors rise and fall at different times. When tech struggles, maybe energy does well. When growth stocks fall, value stocks might rise. That's how diversification is supposed to work. But when 30% of the market is concentrated in a single narrative, there's no diversification. There's just one big bet wearing different disguises. The last time markets got this concentrated, it didn't end well. This kind of concentration makes the whole system brittle. One shock, that's all it takes. And in January 2025, that shock arrived. Appreciate you sticking around. If you liked what you heard, smash that like button, hit subscribe, and drop a comment. I'd love to hear your take. And if you know someone who'd enjoy this, share it with them. Chapter 6. The DeepSeek Shock. Nobody saw DeepSeek coming, and that's exactly the point. January 2025, markets are at all-time highs. AI stocks are soaring. Nvidia is untouchable, the company that makes the chips powering the entire AI revolution. Their moat seems impossibly wide. Competition seems impossibly far behind. Then, a Chinese startup called DeepSeek releases an AI model, not from Silicon Valley, not backed by billions in American venture capital, just a relatively unknown company from China that figured out how to do artificial intelligence cheaper and more efficiently than anyone thought possible. The market's reaction was immediate and violent. Nvidia dropped 17% in a single day, not 17% over a week, not 17% over a month. One day, hundreds of billions of dollars in market value gone just like that. The assumption that American AI companies had an unbeatable lead shattered. The belief that Nvidia's dominance was guaranteed demolished. The narrative that these valuations were justified by insurmountable competitive advantages suddenly looking very questionable. Now, Nvidia recovered some of those losses quickly, bouncing back about 9%. Bulls pointed to the recovery as proof of resilience, but skeptics saw something different. They saw how quickly sentiment can shift. They saw that the unbeatable moat everyone talked about meant unbeatable until someone actually tries. DeepSeek didn't destroy Nvidia, but it did something almost as significant. It proved that the AI giants are vulnerable. It showed that competition can come from unexpected places, moving faster than anyone anticipated. If one startup from China can do that kind of damage in 24 hours, what happens when the next shock arrives, and the one after that? DeepSeek was a warning shot. The question is whether anyone's listening. To understand why the whole thing might collapse, we need to look at something even more absurd than the competition concerns, the valuations themselves. Chapter 7. Valuation Insanity. Let's talk about what things are actually worth, or rather what people claim they're worth. OpenAI's valuation recently crossed $5 trillion. I want you to sit with that number for a moment. $5 trillion. That's larger than the entire GDP of Japan, larger than Germany, larger than the United Kingdom. A single company, valued higher than entire nations that have been building economies for centuries. Germany has 83 million people. They make cars, they make chemicals, they make precision machinery. They have one of the most sophisticated manufacturing bases on the planet, actual products, actual exports, actual value creation you can touch and measure. OpenAI makes chatbots that confidently lie to you, and the chatbot company is worth more. Look at the S&P 500's valuation metrics. American stocks are currently trading at 23 times forward earnings. That means investors are paying $23 for every dollar of profit they expect these companies to make next year. Compare that to the FTSE 100 in the UK, trading at 14 times earnings, or European markets at similar levels. American stocks aren't just expensive, they're expensive relative to everywhere else on Earth. This kind of premium only makes sense if you believe American companies, particularly AI companies, will grow at rates unprecedented in economic history. Not just good growth, miraculous growth, perfect execution, zero setbacks. Prices like these don't leave room for disappointment. They don't leave room for good but not great. They require everything to go right, forever. And when has that ever happened? The P/E ratios we're seeing now echo the peaks of 1999. Same metrics, same justifications, same faith that revolutionary technology justifies revolutionary valuations. We know how that story ended. These valuations assume everything goes right, but there's a cost nobody's including in the math, a cost that's literally burning through the planet. Chapter 8, The Hidden Costs. Here's the expense report. Nobody's showing you. Artificial intelligence is hungry, not metaphorically hungry, literally, physically hungry for electricity. Every query you send to ChatGPT, every image you generate, every AI analysis that runs on corporate servers, it all requires power, enormous amounts of power. AI data centers now consume more electricity than some countries, not cities, countries. The combined computing infrastructure needed to train and run these models is burning through energy at a rate that's straining power grids worldwide. And here's the dark irony. We're burning fossil fuels at an accelerating rate to power AI systems that we're supposedly going to use to solve climate change. We're cooking the planet to generate pictures of cats with too many fingers. But forget the environmental concerns for a moment. Think about this purely from a business perspective. Energy isn't free. As AI scales up, energy costs scale up with it. Every projection about AI profitability is based on assumptions about computing costs. What happens when electricity prices spike? What happens when data centers face brownouts and blackouts because the grid can't keep up? These aren't hypothetical questions. They're already starting to happen. Power companies are scrambling to build new capacity. Utility stocks are rising on expectations of AI-driven demand. The infrastructure required to support this technology doesn't exist yet, and building it will cost trillions. None of this is priced into the valuations. The market looks at AI revenue projections and imagines straight lines going up and to the right. It doesn't account for the physical limits of exponential growth. There's also regulatory risk. As energy consumption becomes a political issue, governments may step in. Carbon taxes, efficiency requirements, restrictions on new data center construction. These aren't far-fetched scenarios. They're conversations already happening in legislatures around the world. Valuations are insane. Hidden costs are massive. Insiders are warning us. So when does this actually end? One analyst has a specific answer. Chapter 9, The Timeline. Q4 2025. That was the prediction. Ed Zitron, a tech analyst who's been tracking the AI industry obsessively, has made a bold prediction. He believed the AI bubble would burst in the fourth quarter of 2025, not sometime in the next few years, not eventually. A specific window, a specific time frame. Now, Predicting exact bubble timing is a fool's game. But if you're going to be a fool, at least be a fool with data. Here's why Q4 2025 keeps coming up. Several converging factors point to that window. First, earnings expectations. By now, investors have several more quarters of actual AI revenue data. The just wait, profits are coming argument will be harder to sustain. Companies will need to show real returns on all those AI investments, and based on the MIT data, 95% of them won't be able to. Second, the rate environment. Monetary policy moves slowly, but by late 2025, we'll have a clearer picture of where interest rates are heading long term. High rates make speculative investments less attractive, money gets more expensive, and companies burning cash get punished. Third, sentiment exhaustion. Bubbles don't pop because people suddenly see the truth. They pop because the last buyers have bought. At some point, everyone who's going to pile into AI will have piled in. When there's no one left to buy, prices can't keep rising. Fourth, the DeepSeek effect. Every time a new competitive threat emerges, it chips away at the narrative of AI invincibility. Since then, how many more DeepSeek moments have we seen? Here's what's strange about this particular bubble. Everyone sees it. The Australian Financial Review called it the most anticipated bubble in history. Analysts are writing about it. Newsletters are warning about it. Even the insiders admit it exists, and yet the money keeps flowing. There's a paradox here. Can a bubble that everyone expects still pop? History suggests yes. Knowing the music will stop doesn't help if you can't time exactly when, and nobody wants to be the first one to leave the party. So, if the crash is coming, the question becomes, who actually survives? Not everyone loses when bubbles burst. Let me tell you who wins. Chapter 10. Who survives the crash? Not everyone loses when a bubble bursts. In fact, some people make fortunes. Remember what happened after the dot-com crash? Amazon fell from over $100 to under $8. $8. If you had the courage and the capital to buy at that level, you would have made 50 times your money by now. More. The people who bought Amazon at $8 in 2001 are very, very wealthy today. There weren't many of them. Most people were too scared, too burned, or too broke after the crash to buy anything. But those who did, they're the ones who benefited from the internet revolution, not the people who bought at the peak. There's always money to be made in a crash. Just ask anyone who bought Amazon at $8, all 12 of them. So who survives when the AI bubble pops? First, infrastructure companies with real revenue, not hype, not promises, actual cash flow from actual customers paying actual money, companies providing essential services that businesses need regardless of whether AI lives up to its promises. Second, open source AI models. When the funding dries up and the venture capital stops flowing, the survivors will be tools that are cheap or free to use. Democratized AI that doesn't require billion-dollar investments. Third, narrow AI applications. The general purpose, do-everything chatbot might be overhyped, but specific AI tools solving specific problems will continue to create value. Fraud detection, medical imaging analysis, supply chain optimization, boring, practical, profitable. Fourth, patient investors, the people who held cash through the euphoria, who resisted the fear of missing out, who waited for valuations to return to something resembling sanity. They'll be able to buy real technology companies at fire sale prices. Bubbles destroy overpriced hype, but they reveal underpriced value. The smart money isn't just preparing to sell, it's preparing to buy. But not until after the crash. The crash creates winners. But what does the world actually look like after the dust settles? Chapter 11. The morning after. The morning after a bubble bursts is surprisingly quiet. The headlines will scream. The pundits will panic. Everyone will point fingers. But on the ground, in the offices and homes of people who actually work with technology, life will continue. This is what people forget about bubbles. The technology doesn't disappear when the stocks crash. The internet didn't vanish when pets.com went bankrupt. The underlying innovation continued, quietly, without the hype. After the crash, we enter what analysts call the trough of disillusionment. The Gartner hype cycle describes this perfectly. First comes the peak of inflated expectations. That's where we are now. Then comes the trough, where everyone decides the technology was never going to work anyway. Neither extreme is accurate. The technology is neither as transformative as the bulls claimed, nor as worthless as the post-crash bears will argue. The truth, as always, lives somewhere in the boring middle. Here's what the post-bubble landscape probably looks like. Venture capital dries up. For years after the dot-com crash, investors were terrified of anything that smelled like tech speculation. Funding for legitimate AI projects will become harder to find, not because the technology is bad, but because the scars run deep. Valuations reset. Companies that were worth trillions will be worth billions. Some will be worth nothing. The survivors will have price tags that actually reflect their fundamentals. Human-AI hybrid workflows emerge. Instead of AI replacing humans, we'll see more nuanced integration. Tools that augment human capability, rather than pretending to replace it entirely. And everyone, absolutely everyone, will claim they knew all along. The same analysts pushing AI stocks today will produce reports explaining why they always had doubts. The same investors who bought at the peak will claim they sold at the top. Memory is convenient that way. After every bubble, the same thing happens. The technology survives, the hype dies, and everyone claims they knew all along. History tells us what happens next. The only question is, what do you do with this information? Chapter 12, Lessons from the Wreckage. Let's make this practical. You've spent the last 15 minutes learning about a potential crash, but information without action is just entertainment. So here's what you can actually do with what you now know. Lesson 1. Measure AI success by revenue, not benchmarks. When someone tells you an AI company is revolutionary, ask one question. Where's the profit? Not the potential profit, not the projected profit, the actual profit. 95% of enterprise AI investments produced zero returns. That's not a technology problem, that's a business model problem. Lesson 2, actually diversify. If you own an S&P 500 index fund and think you're diversified, you're not. You're 30% concentrated in 5 tech companies. Look at your portfolio. Understand what you actually own. Consider international exposure, different sectors, different asset classes, real diversification, not the illusion of it. Lesson 3, watch for AI washing. Companies are adding artificial intelligence to their names and marketing materials just to boost valuations. Before you invest in an AI company, ask whether the technology is real, or whether it's just a label slapped on something ordinary to attract investors. Lesson 4. Remember that real technology survives bubbles. The internet was real. The companies just got too expensive. AI is real. The companies might be too expensive. Don't confuse criticism of valuations with criticism of innovation. The technology can be transformative, and the prices can still be insane. Both things can be true simultaneously. Lesson 5. The best opportunities come after the crash. If you believe in AI's long-term potential, the worst time to buy is at the top of a bubble. The best time is after the crash, when legitimate companies are selling at discounts. Patient capital beats panicked capital every time. You now know more than most investors. The question isn't whether you're informed, it's whether you'll act on it. Will you look at your portfolio differently? Will you ask harder questions about the AI investments being pitched to you? Will you remember this conversation when the headlines turn from euphoric to panicked? So remember, when someone offers you an AI-powered toaster, maybe just buy a regular toaster. Remember this video. The timeline has passed. Look around. Who was right?